Welcome, everyone. Angela just popped on. And when I think about Angela, one of the things I think about is her expertise in health. And I don't know how to say to people, even my ex-wife, Kelly, who started to see my trainer, she's like, well, I'm feeling this, I'm feeling, and I'm like, it's a puzzle, it's a journey. Oh, okay, I have a food sensitivity to this. Well, stop eating that for a month, 3 months, and see what happens. I mean, if you're feeling better, then don't eat that anymore, right? It's kind of like, okay. And so like it's like a journey. Nobody's ever, it's like that gap in the game, like we're planning towards perfection, but we have to turn around and look how far we've come to measure our progress. So whether that's health or that's infinite banking, that's the key is if you measure to perfection, you're never happy, right? If you look back and measure how far you've come, then you think, wow, so we can't get caught up in right now, this isn't working out the way that I wanted to, or I gained 3 pounds, or I feel like crap this week or today. So, it's the same way with building wealth. It's slow, but it's progress. And I think that's the key. I'm always happy when I'm making progress. All right. So build the bank. When to pay back policy loans and when to let them run. Okay. So your policy loan is like a control lever. And what I mean by that is you repay only when repayment increases your control, your cash flow, or your compounding. If it doesn't do at least one of those things better, then it's better to you then if it doesn't do at least one of those things better than your next best use of cash, don't rush to pay it back. Does that make sense? I don't know if I said that the right way, but if you got to either get more control, more cash flow, or more compounding. If you don't get one of those things, then don't rush to pay it back. Okay, so I'm going to explain what I mean because I don't think that really explains it. But let's talk about banks for like what they do, right? Banks make money by never closing their vault. They're always trying to loan money. Be your own bank and act like one by always trying to put your money in motion. And then the mechanics of that actually matter. So just as a review, I think everybody on this call knows this, but a policy loan is collateralized by cash value. You're not withdrawing. You're not borrowing from the company. You're not withdrawing. You're borrowing from the company's general fund with your cash value as collateral. Simple, right? The cash value keeps compounding, dividend and guarantee crediting on the full amount, not net after the loan. And so the cost of the is equals policy loan APR, and then the return equals your alternative after tax, after risk yield, right? So your cost, your return. Repayment is optional, but interest due is not optional. They're going to take that interest, right? So here's the decision. Here's the decision rule, and this is how you decide whether you're paying back the loan. If it's a liability, i.e., consumption, car, boat, vacation, treat it like a bank would, and the bank would treat you and repay on a fixed schedule. No excuses, anything else. Can you skip a payment? Sure, you can skip a payment. Can you do this? Yeah, sure, because you're the bank. But make it up and treat it like the bank would treat your money. Don't value the bank's money more than you would value your money. Okay. But if you buy a cash flowing asset, so that's liability of consumption. If you're buying cash flowing asset like a business, real estate, notes, etc., compare the spread and the durability of that spread. So this is the way that I did it in the very beginning is so the spread is like your after tax yield, okay, minus your loan interest. So if the spread's more than 3% durable, meaning it's going to continue, then don't pay back the principal if you don't want to. I'm not saying, and I'm going to explain that too, because there are times where I'm going to pay back the principal regardless, because I need someplace to hold the money, and it's better than in the banks, in the actual bank. But pay interest on time because you have to do that. Then recycle the excess cash into PUAs on the next deal or the next deal, right? You could add the PUAs, the stuff that extra that's coming in. And this is what Nelson does in the equipment financing example in the book, and also in the IBC sister versus CD sister. So it's either the next deal or PUAs. If it's zero, if the spread is zero or less than 3%, be selective. Slow amortization while you line up a better use for that money. You don't have to pay that back as fast. So if it's less than zero, then accelerate the payment. Meaning if it's a liability like a car or something like that, or you needed to pay off a debt or you needed to replace some equipment in your business, then pay it off until the spread turns positive again. So because some of these things are up and down, right? The spread. So if the spread turns and it goes to zero or less than zero, where there's actual a cost, then you want to pay that back, right? So this durability thing. Okay. So is the yield repeatable? Could be tenant quality, contract, could be churn, could be business margins. Is it durable? And then, your debt service coverage. If it's more than 0.3, that's comfortable. If it's more than 1.5, that's strong. And if your debt service coverage is weak, reduce leverage and repay. Okay, that's pretty simple, right? But if you keep 12, again, the control and liquidity test, if you keep 6 to 12 months of policy loan interest in reserves, okay, then you could always pay that. Now, you don't keep that in a checking account. You keep it back in the policy. You're paying it back and you're like, hey, I got my interest covered for the year. If repaying the policy would threaten liquidity or your ability to pounce on deals, then don't repay it. Now, you might say, well, Jim, if I repay it, I can reuse it again. I agree. But like if it needs to stay out there and just keep turning, if that makes sense. Okay. The last thing before I give an example, if loans are 40 to 50% of your available cash and your pipeline is thin, then maybe you pay back some of the, just to restore the option, just to keep restoring it. But what really happens, and the reason that maybe I'm stuttering a little bit here, is when you flow your money back through there'll be more money flowing back than you can use if you're buying cash flowing assets. Might not happen in the first 3 years, but 10 years in, it happens. And it just won't fit in the policy. If you're buying cash flowing assets that have a good return. Okay. So when I ask people about paying back the loan, this is my easiest example, is if I would loan you $100 million today, would you I'm sorry, let me back up. If I'd loan you $100 million today, and your only obligation for that money is that 1 year from today, you have to pay me $5 million of interest. Simple question. Would you take the loan? And the answer is yes, always, if you know what to do with the money. Okay. So then I give my example if somebody made that same offer to me. What I'm going to do is I'm going to take their $100 million of cash. Now, preferably, and I promise I could find this in within 30 to 90 days. I'm going to take their 100 million and I'm going to go to somebody who has a $500 million portfolio. I'm going to buy that portfolio, assuming everything looks good. And if I do that, I want my cash on cash return to be 25% or more. Okay, so now let's think about that. I got $100 million in handling the seller, and I'm going to go buy $500 million of real estate. And I'm going to make $25 million from that real estate in cash on cash return 25%, just for everybody, if that didn't make sense or follow. Okay, so I'm making 25 million bucks, and it's 1 year from today when I get the loan, and I come and I say, hey, I got your $5 million interest check. Well, at some point in time of me delivering this, they're going to say, Jim, do you want to pay any principal? Now, why would I ever want to pay any principal? Well, one reason I wouldn't want to do it in that scenario is, let's say I paid them $10 million of principal, because I don't really need $20 million, right? Every year coming in, my gosh. Then they could say, hey, you know what? I need that 10 million again. What could they say? They could say, no, I'm not loaning you that 10 million again. Now, if I needed that 10 million to go take advantage or take down some opportunity, I can't take down that opportunity because I gave them back control of that money. It's worth it to me to not pay down that loan to keep the control of the money. And here's one of the beautiful things about IBC. I could pay back anything I want to the insurance company, and they have to give it to me again. They have to, by contract, give it to me again. Anytime I want it, without application, without approval, without anything. I'm in control. I keep control. So one of the biggest mistakes that we make in our lives is handing over control of our lives to someone else, financially, health-wise, medically, spiritually. I mean, we make these mistakes because we're told you're not smart enough, you can't do it. All right. So if we're going to go, let's talk about like when we would absolutely pay back the loan. I do this all the time. I've bought more. I don't even know how many cars I've bought with my IBC system because it's not just my cars. I could count how many I've done in 20 years, but like, it's my kids' cars, my ex-wife's car, not anymore, back in the day. And by the way, she just bought a car using her infinite banking system. Somehow, when we got divorced, she had infinite banking policies as part of the divorce too. So good for her because she has her own bank, and thank goodness she knows how to use it. So she bought a car, she paid it back. But when I do that, let's say I bought a $60,000 car and I have a 6% APR, and there's no offsetting revenue. I'm not renting the car out or something like that. Then I set up a fixed amortization equal to what the bank would have demanded, 48 months. I normally do 36 because I don't keep cars that long. And the reason you do that is there's no spread. Your only return is owning this depreciating toy, but it's recapturing the interest that you would have had to pay the finance company or the bank, or the lost opportunity cost if you paid them cash. Hopefully everybody got one. If that didn't make sense, then please tell me. So I have to pay it back. I have to be honest banker. If that doesn't make sense, go back and read in Nelson's book about stealing the peas. Hopefully, and by the way, if you read Stealing the Peas and it doesn't make sense to you, call me or email me. I didn't get that in the beginning. Like it was like a roadblock for me. And I understand it better than anybody now, because Nelson had to smack me up against the head a bunch of times to get it through my thick skull. Okay, so if we're buying a depreciating asset or a liability, then we have to repay the loan. But let's say that we're going to go buy some real estate, and we put $200,000 down from the policy, and the rental yields 10% after tax, and the loan APR is 5.5%. Okay, so back to our 3% rule, the spread is 4.5%. Pay interest only. Sweep free cash flows to the extra, the PUAs. Then the new deals, once we build it up. Only prepay principal if your pipeline is empty or the spread deteriorates. Again, who's in control of that? You are. You decide. And so that's, again, what makes it so cool. If it was like operating capital, like, bridge for a business or something, and like, here's an example, like say, a 90-day inventory, okay? By flipping a 12% after-tax cycle, and let's say the loan was 6%, just to make the math easier, right? And you could do 4 cycles a year, okay? If that makes sense, flipping that inventory. And if you don't understand like how clothing businesses can mark everything down and still make money, then it's the turns, right? Every business works on turns. The more turns there are, the more money you make. Yes, the spread is important, but the turns are more important. Doctors work off of turns. People painting your house work off of turns. Everybody works off of turns. But if you did, again, if you were getting 12% per cycle, right? Let's say quarterly, and your loan is 6% annually, and you could turn that 4 times, you're getting 40% annualized. Don't prepay. Don't repay. Pay interest only, promptly. Keep cycling. That's velocity. Like, you don't want to worry about that. All right, so let me give you one more example. You lend to somebody. I'll give you another one I just did today. Is a hard money loan. Guy needs it for 10 days. He's willing to pay me 10% for 10 days. This is a guy that I've loaned money to before. I know it sounds risky. Okay. But absolutely, I'll do that. Right. Because that spread is great. Well, now I have that extra money to put into PUAs or to go put into another deal. But if you lend, like, let's make it like different. Let's make it not as big as that, right? As far as the return on private lending or notes, if you lend at 12% and the policy loan is at 5.5% and your spread is 6.5%, then again, pay the interest only, which they're going to take out at the end of the year. You don't have to do that now. I mean, if you want to do it now, you can. And then roll the proceeds, meaning the profit on the loan, to more PUAs. or more notes and more notes. And if the risk rises, then repay it. Again, who's in control? All right. So let's say you're going along and you've done this for 10 or 20 years and you've got this big loan portfolio and you've got all these loans out and you've got millions of dollars of cash, but you've got millions of dollars of loans, right? Well, do you ever repay the loans? Again, we go by those rules, but let's say you get a windfall, right? Every business owner, you're going to get a windfall at times. If you're a real estate investor, you're going to sell a property. Now you got cash. And I'm not saying you're always going to do it, but like, let's say, or always put it back in your infinite banking system, but it's always going to be in your overall system because remember, the policy is only one piece of it, but you sell your business or something like that. All right. So here's the order of operations. What's the first thing? First thing is taxes. One of the CPAs that I used to have that I really didn't like, he'd say, don't be too cute. Well, no, I want to be cute. I want to be aggressive. I don't want to cross the line. Believe in black and white, but I want to go right up to that line. And then one thing that you want to put away, because you don't know, is 12 months of operating plus personal cash, plus premiums, plus PUAs. Okay. So have that liquidity runway, right? Just put that and have that available in cash in your policy. And then kill any bad outside debt. So I'm going to put that money in the policy first. And then I'm going to kill any outside debt. I'm going to take it over. And then I'm either going to pay back policy loans or redeploy. If I have a loaded pipeline, and my spread is plus 3%. Again, if you look, it's not 3% that you're earning because it's what is your cost divided into what are you earning. 3% can be 50% profit, right? Don't zero loans, repay 25 to 40%. And utilization, and then use the rest for PUAs and new deals. And if you have a loaded pipeline. Okay, if you have a thin pipeline, then repay to under 20% utilization. Keep that war chest where where you've got 80% of your money sitting in there, and then hunt deals. Everybody that's in real estate, everybody that owns businesses realizes I'm just hunting for the right deal, hunting for a deal that makes sense that I can make money on. Right. So the timing of the windfalls, if it's early, then the windfall can go to PUAs early, but you got to watch those MEC limits early, then borrow against it when the deal closes. Right. I mean, you can do that. So let's say that you were going to, as an example, had a $5 million sale on your business. And you had $1.5 million of taxes. I hope that you have somebody that's helping you. You're not going to have $1.5 million of taxes. You have $1 million runway and you have $1.5 million outside debt. So $1 million to PUAs, $1 million to reduce policy loans, and $1 million for liquid for deals. Okay. This is just an example. I'm not saying that's the way because it depends on the situation, right? But I hope that the message is coming through that if it's a liability or it's depreciating, then repay the loan. If it's appreciating and the spread is big, like you're buying a cash flowing asset and you have 3% or more, then you don't necessarily have to pay the loan. Hunt for another deal and use that money for that and that and that and that. And the cash flow is going to get so big that you're going to have to start paying back loans at some point in time. Because, at some point in time, you have enough cash flow coming in. You don't need any more. And that keeps on increasing. And so when it increases, what do you do with the excess? Pay back the policy loan. It's not rocket science. And two, you don't have to decide now. You can decide later. All right. So here are some of the kind of guardrails, I guess, is always pay loan interest on time. You can auto pay it, automatic premium loan, right? Just have it come out of the cash value. No problem. And, that's not really even a thing because the insurance company is going to make you pay it. All right. So you're going to pay it one way or the other. And then track your policy loan to cash value ratio, right? 50 to 60% is a yellow light, right? Don't trigger MEC. You really want those things to be down. You want those the policy loan to cash value ratio. You want your money out there moving because money that's not moving is dying. But don't trigger a MEC and they won't let you. They'll make you sign something that if you were going to MEC the policy. But remember, PUAs count, loan repayment doesn't. Loan interest is not deductible personally, but if it can be traced to business or investment or a deductible use that you would be able to deduct it if you borrowed it from any other financial institution, which is what you're doing, then you can do the same thing here. And then match your this is another important thing. This is something that gets violated in the car business every day, is match your loan duration to the asset duration. Don't put a 20-year loan on a car. Okay. I mean, that seems obvious. And then if the car is going to last you 3 years, then pay it back in 3 years. Don't keep on like having negative equity. Like that's what they would have you do if you were borrowing from the finance company. And then the policy equals opportunity engine, not a piggy bank. It's not supposed to be just stored there. Okay. The reason we're changing the name of the community to Wealth Engine is I want to change that mindset. This is your engine to build wealth, your infinite banking system, because nowhere else do you get control. Nowhere else do you get all the tax benefits. Nowhere else do you get an and asset, meaning you get the cash value and you get the asset. You know, that's the simple truth of it. If it's, you know, break even on the spread more than 3%, then you know, like if it's 3% after tax, 6% loan, then you need 9%, right? Because we want to have at least that. If that's, you get to decide that spread, by the way. If it's 3%, if it's 4%, I'm just using 3% as an example. And then, you know, the cash flow priority, base premiums, policy loan interest, PUAs, new deals, principal, only if the spread is under 3% or the pipeline is empty. And liabilities, pay them like a grown-up. Assets, keep the leverage, feed the machine, windfalls, buy control and velocity before comfort. Those are the things that I wrote in my notes. And so the action step is, when you're thinking about this, is run every loan through the spread, not spled, spread plus durability plus control, and set up auto pay for the interest if you want to. And then if you're going to repay the loan on a liability like a car, set up auto payments. Do not count on you writing the check at the end of the year once a year. Finance companies do not let you pay annually. Why? Because that's a big number for most people and they want it every month. They want to make sure. And if you fall behind, you're only falling behind a month, not a year. And then build a 12-month reserve inside the policy. This is where you have protection. And then hold quarterly loan council review stuff. I mean, like in your head, you or with your Create Tailwind coach, your utilization percentage or your pipeline, your MEC, your headroom, your like, you know, all of that. So that's it. I mean, if it doesn't pay you, don't carry it. You're a bank, not a toy store, right? Positive spread you can count on, then don't neuter the goose, feed it. And windfall, test of wisdom, buy control and velocity, not comfort. Those, I guess, are the three things. You know, it's kind of funny. I mean, I hope that makes sense. And what would trigger a MEC, Glenn asked, is in the beginning, let's say your premium was $100,000, Glenn, and it says it'll tell us that if you paid more than $104,917, then the policy will become a MEC. Well, that's that year. But if you didn't pay that year and the next year, then that MEC line would be a little bit different. So let's say that you got a $250,000 windfall and you sent the insurance company a check for $250,000. They would say, hey, we'll take this money, but your policy will be a MEC, not life insurance anymore. And you say, well, I don't want that because all of the consequences of that. That's what would trigger a MEC, is you're putting too much money in it for that death benefit. Okay, so that's when you would expand or whatever. Or you just hold the money for the next deal, or the next year's premium, or you wait until you could pay it without causing a MEC. And then Nathan says, from my experience, my policies, company holds back the prorated amount of, so they hold back the interest. Exactly. Because they hold back the interest, Nathan, they're going to help you be disciplined in this. But in my explanation, I had to decide, like, do I just say that? Or do I say why you would want to keep paying like every month or whatever? Or should, in your mind, you're accounting for it every month, even if you're not paying it. And so, yes, and just to wrap up with this, because I know we're going over on time, is if you take a loan on the first day after the anniversary of the policy, you're going to get about 95% of your cash value. And every day they hold back the interest between that day and the next anniversary so that you could pay the interest for that year. So they hold back that little bit. That means if you did it on the last day before the renewal. So I'm going to take a loan today and tomorrow my policy renews. I can get 100% of my cash value because what are they holding back? Nothing really, right? If it's halfway through, then it's a couple percent. If it's, so up, that's why we always say up to 100% of your cash value you can borrow. Okay. I hope that makes sense. If there's any questions or like next week, if, hey, Jim, that didn't make sense what you're saying. This is easier written out than just talked about. But when to pay back your policy loans, and here's the great thing. You can always change it. You can always change it. You are in control. Wealth is not about how much your income is, how much your cash flow is. It's about your control. And wealth and your health is, if you're not in control of your health, then you're not healthy, right? If you're not in control of your spirituality, you live in a country where you can't worship God, or you're persecuted because of your worship of God, you're not in control. You're not free. And true wealth, not just money, not just financial, like health, everything else is about freedom. And all you need, the only luck you need is time. Time is freedom, not how much more time you have on this earth before you graduate, because none of us are guaranteed the rest of today, but it's the time that you get, because the rest of today, I know what I'm going to be doing. I'm going to be doing what I want to do. But if I had to go to work here in 30 minutes and I had to work till 11 o'clock and I have to do what everybody else tells me to do, then I'm not in control of my time. And if I have to eat McDonald's, which I never would, then I'm not in control of my health. And if I have to go to the doctor and I have to take the meds that they give me, that she thinks I need, the antibiotics or the high blood pressure, whatever it is, then I'm not in control of my health, right? I'm not in control of my medical conditions. She is, the doctor, and we want to be in control. Because believe it or not, you are your best advocate, and not the doctor, not the financial planner, not the bank, not the IRS, you. So what you have to do is take control to have freedom. And how do you do that when you don't know what to do? Get a coach. That's it. I hope that was good today, guys. I know that was a lot. Thank you, Angela. Angela says that was great. And one of these topics, we're going to just I want to compare health and financial and why it goes hand in hand. And it's the same pattern. When you get this pattern down, you get good at it, you can have the best health that you can have, and you can have the most wealth, not wealth, because wealth is all of it, is you can have the most financial reward that you could possibly have too. So anyway, I appreciate you guys. Godspeed, and I'll see you next week. Thank you all.